Awesome. So I'm excited today on the Insurtech Leadership Podcast to be joined by Jessica Leong. She is co-founder of Octagram Analytics, the team behind FireRQ, a non-catastrophe fire risk model that delivers a clear, actionable risk score for any address in the United States. While much of the industry focuses on headline-grabbing catastrophes, Octagram is tackling the everyday fire risk that quietly drives loss ratios, underwriting decisions, and portfolio performance. In this conversation, Jessica shares how FireRQ was built, why non-cat fire risk is often misunderstood, and how data science is reshaping underwriting discipline, pricing, and portfolio management across carriers and MGAs. Welcome, Jessica.
Yeah, no, Josh, thank you. What a great introduction.
Sure. Well, I believe this is your second time on the podcast, and so thanks for joining again. Excited to continue the conversation, but maybe for those who didn't see the last episode some time back, or aren't as familiar with your company or your work, you could maybe share a little bit more about your background, how it led to founding the firm, etc.
Yeah, great. So I founded Octagram 4 years ago now, I think. And so Octagram, we're an actuarial analytics firm. And yes, we've created our first product, FireRQ, and we can talk more about that. But in terms of my background, before Octagram, I was head of data and analytics at Zurich North America. So the team I had there built all the predictive models for pricing, for claims, etc. And I was also formerly president of the Casualty Actuarial Society, which of course was a huge honor.
Yeah, great. So, I think wildfire has certainly been a big headline risk, but maybe the type of fire risk that FireRQ is focused on is a bigger everyday risk. But I don't know, maybe you can talk about the genesis of the product, and we can kind of go from there.
Yeah, definitely. So yeah, you're right. Every time I present FireRQ, I always have to start with, this is not a wildfire model. It is just a run-of-the-mill, you're cooking and the building burns down kind of fire, right? And no one talks about that anymore, but it's still a very, very real risk, right? If you look at just, loss ratios in homeowners or in commercial property, it can make up like 15 to 30 points of your property loss ratio, right? Which is definitely not nothing.
Yep.
But I think no one talks about it anymore because people feel like it's sort of, it's what a lot of property and casualty insurance was founded on, right? Just this fire risk. And I think people feel like it's well understood and there's nothing new under the sun. But we're here to tell you there is. And the reason we built it is because we came across a data set and now we have 1.7 million fires as reported by fire departments across the US, right? And from this data set, we have some pretty cool new insights for the insurance industry. I'll tell you, it's game-changing because fires are so rare, right? I've worked in-house before, and it's very common. If anyone listening to this has had this experience, but it's very common to look at your results for your property book in a given year and see a handful of large fire losses, and it has completely tanked your book, right? And you're wondering, okay, am I missing something or is this random, right? And you don't know because literally it's like 4 claims or something, right? That is a very, very common experience because it is so rare, but when it happens, it's very, very severe. And that's really why we built FireRQ, right? We have almost 2 million fires in our data set, right? Even massive Fortune 500 companies that write this risk have 1% of that, right? So we can look at 100% of the data where you're staring at 1% of the data. So we can definitely get insights around fires that you could not hope to get with the data set you have.
So I have to say, I have a bit of a recent personal experience with this, in that, unfortunately, there are others who've had far worse scenarios, but I was staying in a hotel and actually was visiting my kids at college. And anyway, we'd had kind of a long day. I think I was helping one of my sons move in. And so ended up going back to the room a little bit on the earlier side, put a football game on or something, sat on the bed, dozed off, and woke up to smoke in the room. And there was some kind of issue with the light fixture in the bathroom. And needless to say, I was shocked at how fast the fire spread. Fortunately, the sprinklers did what they were supposed to, but I kind of could see how if something doesn't work right from a sprinkler point of view, or whatever reason the structure isn't properly been monitored, or whatever the case may be, how a big hotel like that could go up and cause a lot of damage and a lot of hurt to a lot of people. So anyway.
Yeah, I'm sorry. That must have been terrifying.
Yeah, well, it was a little strange. It was a little strange, but fortunately, like I said, the sprinklers did what they were supposed to, and but I was shocked at how fast this light fixture went up, and suddenly the whole bathroom was on fire. But anyway, so I'm curious, like how did you come to acquire this set? Did you see insurers like trying to address this non-cat fire risk and struggling with it, or how did you kind of come to decide to do this?
Yeah, great question. No, we came across, look, I will say the data set is completely publicly available, right? So you can have a look at it. It's called the National Fire Incident Reporting System. And so, yeah, we came across it and immediately thought this is actually gold, right? That being said, it took us about 2 years to clean the data. Fire departments respond to a lot more than just fires. A lot of the data is around EMS. Mm-hmm. And then there are a lot of vehicle fires and trash can fires, etc. So it does take a lot of cleaning, and then a lot of work to actually extract all of the actual insights from it. And look, Josh, can I go into some of the insights we have? Because I'd say they were probably in 3 different areas. So one is about repeat fires in buildings. We definitely see that's a thing. Number 2 is clusters of fires. And it's interesting you mentioned, you have this terrible experience in a hotel, but we definitely see clusters for hotels. And then the last one is about trends over time and how fires, it's really interesting to see how fires emerge and how that's been changing over time.
Got it. And so what's the extra the value, or how much better from an actuarial point of view can the analysis be having such a larger data set versus what most folks are working with now?
Yeah, I'll give you an example, right? So one is you can actually start to see clusters of fires, right? So when we look at these 1.7 million fires, we could have seen that they're sort of randomly spread over the US. We did not see that. We definitely saw clusters of fires, and definitely clusters by occupancy. So actually, a good example actually is for hotels. So we see a lot of fires in Myrtle Beach, in like a single zip code in Myrtle Beach. Every year, just hotels as well, right? If we just focus on hotel fires in Myrtle Beach, every year there are probably between 10 and 15 hotel fires in like a single zip code, just hotels. That's a lot of fires. Even though there are a lot of hotels there, that's still a lot of fires. And we publish this in our little book of fires. So, for those listening, if you're interested, it's free resource on our website, Octagram Analytics. And since we published it, we got another year of data from the NFIRS, the fire events, and it's predictive. Like we still saw like another 12 hotel fires in that zip. So that's one. clear insight. And you definitely wouldn't get that from just looking at your own, like unless you happen to insure all the hotels in Myrtle Beach,
Right.
you wouldn't get that from your own data set. And we see that across lots and lots of different occupancies. And then I think the repeat fires is also an interesting thing. So one easy thing to do is just look up and see, has this building had a fire before, right? And for sure, you can actually, when you underwrite an account, you can ask for the last 3 years of claims and you'll get some of that. But we actually see value in going back more than that, like going back at least 10 years and seeing if a building has had a fire before. Because we do see that having a fire before is predictive of loss in the future.
So is the value in FireRQ, sorry about that, in the data set, or are there certain things you're doing with the modeling piece as well?
Yeah, great question. We have built a predictive model to bring all of the data together and build something that is truly predictive of fires above and beyond what people are already doing.
Got it. And so have you been working with this long enough to see which, signals or variables matter the most in understanding everyday fire risk that maybe other models might overlook?
Yeah, we have. Look, honestly, a lot of what drives our model is looking at the fire experience in the area, right? If it's been particularly bad, especially in that occupancy as well, if it's been bad for that occupancy in that area, then we will produce a pretty high fire risk score, essentially. We have lots of other variables in our model, some of which are proprietary. But a lot of it is just about past experience. And we start fairly specific, like literally this building has had a fire before, and then we branch out, right? In this very near area, if we're trying to, for example, produce a score for a hotel, in this area, do hotels generally burn down? In the broader area, do hotels generally burn down? In this broader area, do other commercial occupancies often burn down or not, right? And that forms a lot of our prediction, along with a bunch of other variables.
So how exactly would underwriters use a score that the model generates?
Yeah, great question. You can use it for pricing, for risk selection, or for other, a risk inspection, for example, other operational use cases. So what we do with clients is we do allow a free proof of concept. So we'll score their exposed book for a few years using an old model. That's kind of key, actually, because we have your fires. So you just have to trust us that we're not cheating. We're using an old model that doesn't have those fires that you're trying to test against, and see if we could predict the fires that you actually had, essentially, right?
Interesting.
And then so sort of the proof is in the pudding, right? You don't need to just listen to the spiel. You just see if it works for you or would have worked for you. And if it does, then what customers have done is use it for either rating or for risk selection, depending on the level of the signal. So if you're finding that, anything with a really high FireRQ score, say in the 90th decile or more, right? It's like the 90th percentile highest risk restaurant in the country, we're just not going to quote it, basically.
Got it. And so in terms of the workflows they're used to, or the models they're used to, and things like that, like, are there certain things you have to do in order to get FireIQ sort of integrated, or explain to them how to use it that might be different than the way they're using models for scoring fire risk now?
Yeah, great question. At the moment, no. We have an API. It produces a few different scores with different contexts attached to it. And then a lot of the times the clients are frankly fairly self-sufficient and don't give us a lot of detail on exactly how they're using the model. That being said, as we've been doing more and more POCs, we're finding with the larger accounts, they want more. We're working to get more more data as to why it's getting the score it's getting, right? So we will always provide information if we see any prior fires in that location in quite a lot of detail. But we're working to say, we're giving you a high score because we see, there've been 7 fires in this general area and laundromats, right? And you're trying to write this laundromat. And that's very high. Usually we would expect 1 or something, right? Like if you look nationwide, that's the level of context. Yeah.
Got it. Would you be able to share any examples where FireRQ has materially changed a pricing or an underwriting decision?
Good question. A lot of Josh, I'm sorry, we're under NDA.
But maybe, I know you can't share maybe a specific organization or property, but maybe just sort of on a anonymized basis, any cases or no?
Yeah, definitely. We also have consulting clients, and as we work with them on FireRQ, certainly they are looking at it as a early warning sign, right? Where, if it has a really, really high FireRQ score, just this is not one we'd actually even quote as an example. So that's certainly, a fairly definitive underwriting decision.
And is there technology underlying this from the analysis point of view? Is this traditional actuarial science? Is there AI or machine learning, or how exactly are you?
It's machine learning. So we're using a GBM to build our model. It's not. We haven't used any generative AI, but it's a fairly sophisticated predictive model.
Got it.
Yeah.
And had you done this sort of predictive modeling before, or what was it like going from consulting to actually building a product?
Yeah, great question. So I used to be head of data and analytics at Zurich North America. So certainly, and I spent 7 years there. So certainly lots of predictive analytics under the belt. And predictive analytics, it's interesting to do it in-house as well, right? Because you actually see whether it's going to have any impact or not, right? And now doing it again in my own consulting firm, it's been a really interesting experience. Number one, I'm thrilled that we're able to give people very specific insights about this risk, right? We don't write any business. We don't have any, of our own proprietary data. Yet we can tell people who've been writing this risk for years things they didn't know about fire risk, right? So that's been really great. And then as we've been testing the model on various clients, both big and small, homeowners and commercial property, that's been a really interesting exercise as well, trying to read between the lines and what they're able to share with us and working on how to improve the model going forward. Yeah. And I'll say, Josh, one of our key pushes for this year, we're thinking about strategy. We would love to, I think the next move in improving our model is actually seeing if insurers and small MGAs are happy to share their data with us, right? I think that's the next frontier.
Got it. And has it been different building predictive models now versus when you did it before?
Good question. Not different in terms of the tech available. I'll say that. Only different because my circumstances are different, right? I have far less access to insurance data than I used to. But look, in terms of all the developments we've had in AI, not really, right? Because I'm not using any. It might be if I was using lots of text-heavy data sets, right? And AI would certainly help with that, but I'm not. So I'm not seeing that any of that generative AI advances is actually helping with being more predictive. I'll be honest, fires are really rare. The data set is big, but it's not 1.7 million is not big in terms of big data, right?
And so you mentioned that clients kind of wanted to know more about why. So how important is model transparency when you're working with, underwriters, regulators, anyone else who you have to deal with this product?
Yeah, good question. I will say our model isn't filed, and we have no immediate plans to file it. It being a quite costly and long process. We built it. I actually have just a personal preference towards model transparency. But we built it as a GBM just because it works better, right? It actually is more predictive. In terms of model transparency, it hasn't been a massive issue yet. I think folks who've been testing it out are just happy to see that it works, right? And that, yes, we can capture, when we test it ourselves, right, within our own data set, because we have fires in a year, we can hold them out and say, okay, haven't seen these, can you predict them? We see we can capture like 80% of fires and the top 20% of risks. So if we tell you these buildings are the worst 20% buildings in the US, we do see they have 80% of the fires. So that's good, right? We think that's good. So yeah, for now, people have just been happy with the predictive power.
Yeah.
And then the transparency. Yeah, it's nice to have. And certainly when things are large and heavily underwritten, if something gets a bad score, they definitely want to know why, especially if it looks fine, right? Why is this getting such a bad score? So that's probably more of the pushback we've gotten, not so much the regulation. Yeah.
I mean, are you finding insurers are seeing sort of this quantified risk differently across their book? And does it influence portfolio strategy? Does it get into reinsurance conversations in any way?
Yeah, good question. Definitely quantifies risk differently across people's book. It hasn't, other than saying that highly scored accounts just don't get quoted. I mean, I guess that's obviously influencing portfolio strategy.
Yeah.
But it hasn't caused someone to think, oh, I'm just going to stop writing this class completely in this area or anything like that, right? It's fairly pinpoint.
Yeah.
Yeah.
And do you think carriers will treat this as more of a core risk as they see this data, or how do you think they'll approach it?
What do you mean by that, Josh? Because I think carriers, they know that they have fire losses. Yeah.
How they think about non-cat fire risk versus cat fire risk, or prioritize the thinking around it.
Pay attention to it. Good question. By the time that folks come to us, they probably already know they have a problem, right? And it doesn't take much because, again, you're going to have a bunch of fire losses. And then there will come a time when you have more than you were hoping you'd get. And even a little bit more is going to potentially tank your book, right? Because the fire loss on average is in the hundreds of thousands, right? They're big claims. I think what we remind them when I talk to new prospects is that actually there's something out there. And yes, this is a big risk. And then not often, sometimes people do need to go back to their teams and say, hang on, what does our fire experience look like? Is it good? Is it bad? So maybe we remind them to just to look, and also that, there's something out there in case, this is an issue.
Are you planning to roll out additional products after this, now that you've kind of got your first product into the market?
Yes. So we have, and you've interviewed lots of startup founders. I'm sure what you're supposed to do is focus on one thing and just make sure that launches properly. But in the works, we have liability RQ, right? And a crash RQ as well. The name is in the title. Yeah.
Got it. So maybe flipping around to the other side, is there any advice you would give to underwriting leaders trying to, modernize their approach to risk selection without overwhelming their teams?
Yeah. Yeah, good question. Focus on what, I agree with that. Look, all these underwriting dashboards, you have like 1,000 things pointing at you, right? Focus on what you think actually moves the needle and matters. Look at your actual losses. Is it fire? Is it water? Is it something else? Frankly, it'd probably be those two things if you're writing property, right? Or is it cat, right? And then you're right. And we're working on this, but all the insights need to have a reason behind them, right? So my 7 years in-house, you can't just give someone a number, right? 7, like, okay, what am I supposed to do now? Like, is a 7 bad or is it good? And why is it a 7 and not a 10 or a 3? And what am I supposed to do now with the 7, right? Yeah, the more clarity you can provide around that, the more, the insights are supposed to be actionable, right? So yeah, the more action you'll see.
And I know you still have the consulting side of the business. I mean, do you see the role of actuarial consulting changing at all, or how you're going to approach it as you get more into products?
No. So look, we build pricing models for small insurers and MGAs, right? And I don't see that changing significantly. I'll say with the dawn of AI, the one thing that is changing, especially since we deal with such small companies and startups, we have this rate filing tool we've been using, Matt Risk, I'll give them a plug, but like it uses AI. It's just amazing. Like so now all of that is so much easier, right?
Yeah.
So that's probably the only major change, but honestly, insurance and data, we have barely any data in the grand scheme of things. That's still the traditional way and the traditional methods we've been going about it, with a touch of AI, of like, GLMs and predictive models and stuff. It's still the best we got, right?
Yeah. So Jessica, anything we haven't covered that you'd like to touch on today before we wrap up?
No, I think we're good. But yeah, we're super excited to have launched this product. We've had a really good reception in the market. And again, it's something meaningful, but people don't talk about it anymore. So I'm glad we're talking about it.
Yeah.
Yeah, thank you, Josh.
And where can people find more information or contact you if they'd like to learn more?
Yeah, octagramanalytics.com. Yeah, please come to the website. You can grab our little book of fires. It's a good read.
All right, cool. All right, well, Jessica Leong from Octagram Analytics, thanks so much for joining me today on the Insurtech Leadership Podcast.
Great. Thanks for having me.